Trial balance performs check of double entry bookkeeping process. There are actually two functions of trial balance, and the first one is trial balance is used to check the arithmetical accuracy of double entry system. Number two, foundation for preparation of financial statements. You know that after balancing all the ledgers, we transfer the balancing figures to the trial balance. From trial balance, these amounts and these figures will be transferred to the statement of profit and loss or statement of financial position. So it provides a foundation for preparation of financial statements. When we say that trial balance can be used to check the arithmetical accuracy, we must consider another thing. Trial balance will reveal few errors, and there will be few errors which will not be revealed by trial balance. So then let's discuss errors and the trial balance. In this topic, first of all, I would like to discuss errors not revealed by trial balance. The first one is error of principle. Error of principle means where a transaction has been entered wrongly into wrong type of account. For example, an asset has been recorded into an expense account, or an expense has been recorded into an asset account. Such errors are called errors of principle. Error of commission. There is a very little difference between error of principle and error of commission. I've used the word where a transaction has been recorded in wrong type of account is called error of principle. So there were two different types of accounts. One was asset, one was expense. However, in error of commission, where the type of account is correct, for example, asset has been recorded into a different category of assets. An expense, for example, electricity expense, has been recorded into the insurance expense. So such errors are called error of commission. Like accounting heads of both of the transaction of the account involved in it is the same, but it's not the right one. For example, insurance expense recorded as fuel expense instead of the correct one. So this is called error of commission. The third one we have error of original entry, where wrong amount into both double entry accounts. For example, someone has paid £100 as an insurance expense. So expense has gone up. The normal dealing with this such a transaction is you debit the expense account, which is your insurance, and then you have to reduce your bank account and you will credit it, but with £100, because £100 was the expense. But what the accountant has done over here, instead of £100, he has recorded 110. You have given him a receipt, he has come to know, but there might be any reason, and he has recorded, instead of 100, he has recorded 110 on both accounts, in both accounts. The next one is error of omission, where a transaction is completely omitted. Neither the debit side nor the credit side has been recorded in the books of accounts. So such an error is called error of omission. Reversal of entries. Debit and credit entries are made on wrong side of both accounts. For example, I was just discussing the example of insurance and bank account. Now, if somebody has paid for the insurance, what he will do, he will debit the insurance account, because that is your expense. You have to increase. In order to increase it, you have to debit it, and then you have to credit the bank account, because bank has gone down. You have paid for the insurance from your bank account. So in reversal of entries, instead of doing this way, like debiting the expense, crediting the bank account, the accountant has debited the bank and credited the expense account. So this is called reversal of entries. Then we have few errors which will be revealed by the trial balance. In this we have one-sided entry. Only one part of the two parts of a double entry transaction has been made. Same example, insurance. expense. So he has recorded debit insurance account, but he forgot to record credit the bank account. He has credited the bank account, but he forgot to debit the expense account. So one side of the entry is missing. Then we have entry duplicated on one side, nothing on the other side. Two debits or two credits have been recorded. Same example. £100 insurance expense was paid. Accountant was supposed to debit insurance expense by £100 and credit the bank account by £100. Instead of it, he has debited the insurance expense twice and he has done nothing with the credit side. He has credited the bank account twice and has not done anything at all with the debit side. So such entry is called entry duplicated on one side, nothing on the other side. Then we have unequal entries, where different amounts have been recorded for debit and credit. Same example, £100 insurance expense was paid by bank. Accountant has recorded £100 on the debit side of the insurance expense account, but on the credit side of the bank account, the other part of the transaction, he has not recorded £100, rather he has put £110 in the credit side of the bank cash book. This is called a mistake of an error of unequal entries. Account balance incorrectly transferred to the trial balance. When we finish with all these bookkeeping, when we record all the transactions in their respective ledgers, we have to balance it. What if an accountant or a bookkeeper has not calculated that balancing figure correctly? One account, for example, insurance, like he was recording all the insurance expenses for the year. At the end of the year, it should be £1,200, but instead of it, any calculation mistake, he has recorded £1,400. He has put an extra zero. So such an error where account balance incorrectly transferred to the trial balance, these are the errors which will be revealed in the trial balance. So after discussing trial balance, its functions and errors revealed and not revealed by the trial balance, there are few limitations of trial balance as well. Errors in the double entry bookkeeping not revealed by trial balance, as we have discussed earlier. There will be few errors which will be revealed by the trial balance, but there are few errors which will not be revealed by the trial balance. Trial balance only cannot provide information about figures related to the statement of profit or loss or statement of financial position. For example, you have given a trial balance. You don't know what figures should go to profit and loss account and which figures should go to balance sheet. So if you are just presented, if someone who is not aware of these accounting things and he is presented with the trial balance only, he cannot judge or he cannot calculate the profit and loss or the financial position of the business. Two-column trial balance does not give a profit figure, of course. Just like the previous point, you got just debit side, credit side, but you don't know how to get the profit or how to calculate the loss of the business. Closing inventory needs to be recognized in both statement of profit and loss as part of cost of sales, cost of goods sold, and statement of financial position as an adjustment to trial balance. We will discuss this in details. Trial balance and extended trial balance. Extended trial balance gives an understanding of principles of financial statements. First step for preparing financial statements. Adjustments are made in the extended trial balance. Adjustment means accrued income, accrued pay, expenses, prepaid income, prepaid expenses. So such adjustments, to record these adjustments and to bring the accounting records exactly up to the mark, up to the date, following all the accounting principles, we have to draw an extended trial balance. Financial statements, we have two major financial statements. The first one is statement of profit and loss, also known as income statement, and the second one is statement of financial position. So statement of profit and loss, income minus expenses is equal to profit or loss for the year. Income greater than expenses, then of course profit. If income is lesser than expenses, loss. Profit or loss belongs to the owner or owners of the business. Sales revenue minus cost of purchases of goods and adjustment for change in inventories equals gross profit. Sales revenue, income, minus cost of purchases of goods, the things you're selling, and adjustment for change in inventories. Change in inventory means how much opening inventory you were having at the start of the financial year, and by the end of the year, how much goods have not been sold. What is your closing inventory? So after recording all these adjustments, sales revenue minus cost of purchases of goods and adjustment for change in inventories gives you gross profit. From gross profit, when you deduct all expenses, wages, admin expenses, like electric expenses, telephone, insurance, all that, then gross minus all other expenses gives you profit for the year. Assets. Non-current assets comprise long-term items owned by the business. First, we have tangible non-current assets, non-material substance, for example, goodwill. Tangible non-current assets have material substance, for example, premises, vehicles and machinery, etc. Current assets, short-term assets which change regularly, for example, inventory held for resale, trade receivables, VAT repayable, bank and cash balance. Liabilities are obligations a business has to meet in the future. Same. Current liabilities where payment is due within 12 months of the date of the financial position, for example, trade payables, bank overdraft, VAT payable. Non-current liabilities where payment is due in more than 1 year from the date of the statement of financial position, for example, loans, mortgages, and long-term bank loans. So net assets, we have studied non-current assets and current assets. So if you add non-current assets and current assets, and also we have studied current liabilities and non-current liabilities. So if you add current assets with non-current assets and current liabilities with non-current liabilities, and then deduct from all assets like current and non-current assets, you deduct current and non-current liabilities, that gives you the figure of net assets. Capital, where the resources to finance the business have come from owner's investment and any retained profit in the business.